hi there, and thanks for joining me for the accounting and finance coaching sessions. I remain your coach, Echela Okwori. So, very quickly, we're going to continue with our investment appraisal techniques. Remember that we've already looked at the payback period. Next, we want to look at the accounting rate of return. Now, this is what we want to look at. The accounting rate of return is also very simple and very easy to understand. Basically, it has to do with the average annual profit of the entity, of the project actually, divided by the average investment of that project. Now, when you look at these two, you now have what we call the rate of return for that project, the accounting rate of return for that project as calculated. Now, to know whether the project is to be accepted or rejected, you compare it with the target rate of return that is set by the entity for project appraisal. For example, the entity sets, let's say 20% as the target ARR. That's the accounting rate of return. Now, if what you calculated is up to 20, it is accepted. If it is less than 20, it is to be rejected. If it is more than 20, the more the merrier, is to be accepted. Very quickly, now let's go and look at a question. Let's do justice to the accounting rate of return by looking at a typical question. This question says, a company is considering a project which requires an investment of 120,000 naira in machinery. So we'll call that our initial outlay. We'll say initial outlay. For machinery is equal to 120,000. Good. Now let's extract another point from the question. Let's say the machinery will last for 4 years. For 4 years. So the lifespan of the machinery, of the project, lifespan equal to 4 years. Good. After that, it will have a scrap value of 20,000 naira. Scrap value is 20,000 naira. Good. The investment in additional working capital will be 15,000 naira. So there will be an additional, that is, there will be investment in additional working capital. You know what the working capital is? That is the current asset less the current liabilities. In other words, it is the capital that you use in running your day-to-day activities. So we're told that there will be an investment in additional working capital, which will be 15,000 naira. In other words, that amount will be, so we'll say working capital equal to 15,000 naira. Good. Now the expected annual profits before depreciation are, so we'll say inflows. Let's say cash flows is equal to year 1 is equal to 45. Year 2 is equal to 45. Year 3 is equal to 40. I hope you can see the board. So cash flows for year 1 is 45,000. Year 2 is 45,000. Year 3 is 40,000. Good. Now we have year 4, 25. year 4 is 25,000. Good. The company requires a minimum accounting rate of return of 15% from projects of this type. So the company has a target. In other words, they're telling us that for projects of this type, of this kind of machinery, the minimum accounting rate of return is 15%. So we say minimum accounting rate of return is equal to 15%. Accounting rate of return is measured as an average annual profit. It's measured as average annual profit as a percentage of the average investment. Should the project be undertaken? That is a question. Now, the accounting rate of return considers accounting profit. Accountants look at accounting profits, not cash flows. Now, what is the difference between cash flows and accounting profit? The accounting profit removes items like depreciation, like impairment. So in this question, we have a depreciation, and the accountant, to arrive at his profit, must, of necessity, remove his depreciation to get profit. So our formula for ARR is equal to average accounting, I'll say average annual profits. Let's say average annual profit all over average investment. Good. That is the average annual profit all over the average investment. Now, how do we get our average profit? Let's look at our average profit. Average profit. So, the average profit, we are going to add 45,000 plus 45,000 plus 40,000 and plus 25,000. What will that give us? Let me just use this. So in the exam, you can use a calculator, of course, we know that. And also in real life, you can use your Excel to calculate so that you don't make any mistakes. Yes. So I'm not going to calculate off my head. Let me just use this. So we'll say 45 plus 45 plus 40 plus 25. And that gives us 155. Which is equal to 155. Good. So we have 155. But is this our average annual profit? No. Is this even our profit? No. Because we have not taken into cognizance depreciation. Now let's go and calculate our depreciation. So we can say depreciation is equal to, how do you know your depreciation in this question? The question says we have an initial outlay of machinery of 120 and we have a scrap value of 20,000. Now it means that what the difference between the amount you are spending from the beginning, which is 120,000 naira, and at the end, that same amount you spend is now worth only 20,000 naira. The difference, what has gone out of this 120 to make it less, to make it left with 20,000 naira, is your depreciation. Because the depreciation is a reduction in the value of an asset as a result of what? Tears, wears, obsolescence, and other factors. But when we get to depreciation, I'll tell you more about that. So that we don't waste time on this simple question, we'll say the depreciation is simply 120,000 minus 20,000. And what do you have? You have 100,000, which is equal to 100,000. Now, when you remove 100,000 naira. From here, you say 100,000. What do you have? You have 55, which will give you 55,000 naira. Good. Now this is our cash flow. This is our annual cash flow, basically. And for us to get the average, how do you calculate an average? Your simple statistics is the total of the items in your observation. The total of the items being observed divided by the number of the items. So how many years do we have? We have 1, we have 2, we have 3, we have 4. It means to get the average, we'll simply divide by 4. Now if you divide 155,000 by 4, if you divide by 155, that is 55,000 divided by 4, we have 13,750, which will give us 13,750. Now this is our average annual profit. This is the average annual profit, 13,750. Now let's go to the average investment. Let's go to the average investment. I'm sure I can claim this. I can claim this. Good. I can also claim this. I can clean this. I can also claim this. Good. Now, the average investment is the initial outlay. Okay? The initial outlay plus the scrap value. So, we're looking at the average. That is, you say let's say average investment. Average investment is equal to the initial outlay all over, the initial outlay plus the scrap value, divided by what? Do we divide by 4? Of course not, because the items being observed are just 2. You have the initial outlay and you have the scrap value. So in this case, we are not dividing by 4 like in the other, in the average annual profit, where we have to divide by 4 because we are looking at 1, 2, 3, 4 years. Here we are looking at only 2 items, which is the initial outlay and the scrap value. So we divide by 2. Now, after dividing by 2, don't forget that we have our working capital. So we can now, after getting this, we can now say plus the working capital. This will give us the average investment. Now, to do this, to work this out, this will give us initial outlay is 120 plus scrap value, which we have, the scrap value is 20,000 divided by 2. Now, if you add this to this, what do you have? You have 140,000 divided by 2. 2 here, 1. 2 in here will give us 7. So your answer is 70,000. Now we add the 70,000 plus the scrap value, which is 15,000, and that will give us 85,000. So in all, our average investment is 85,000. Now let's get the ARR. The ARR will be 13,750. 13,750 divided by 85,000, and then we'll take the percentage by multiplying by 100, which will give us 16%. So our calculated average rate of return, average accounting return, I beg your pardon, our average ARR is 16%. Now when you compare this with the target, you can see that 16% is higher than the set target. And what this means is that we accept the investment based on the calculated ARR. So if you have an ARR calculated that is less than the target set, you reject. But in this case, our 16% calculated ARR is more than the target set of 15%. What is the decision rule? The decision rule is that if the calculated accounting rate of return is up to the minimum, that is the minimum requirement that is set, if it's up to it or more than it, then you can accept. In this case, the rate of return, what the organization will get on the project, if it undertakes it, the project will be so good that it will do better than 15%. If what we calculated had been less than 15%, like 14 or 13 or 12 or 10, then the project would have been rejected. So that is the accounting rate of return. Now, what are the advantages of the accounting rate of return? Let's look at the accounting, that's the advantages, and we'll also look at the disadvantages very quickly. So after this, we can now go to the discounted cash flows and look at them. We'll look at the NPV, and we'll also look at the internal rate of return. So what are the merits? Merits of ARR. One, it is simple to calculate. And two, it is easy to understand. Simple. It's very easy to calculate, and it's very easy to understand. Remember, we just did it. We just did an example, and as you could see, it's so very simple for you to understand and also for you to calculate. So, but let's look at some of the demerits, some of the disadvantages. One is that it does not consider the time value of money, and that is the most important disadvantage. It does not consider the time value of money. And as I explained to you before, the time value of money is saying that 1 naira today is more than 1 naira tomorrow. And why is that? It is because there is inflation, there is uncertainty, there is risk. And so when you have 1 naira today, it is assumed to be much more than 1 naira tomorrow. So the accounting rate of return, just like the payback period, has that shortcoming. It does not discount the cash flows. It does not discount the cash flows. And when it does not discount the cash flows, it means it does not take into cognizance the time value of money. Good. So does not take into account time value of money. The second one it does is that it does not consider the timing of the cash flows. It does not care about the timing. It just takes an average. You know, like the payback period takes into account the timing. In year 1, this is what you get. In year 2, this is what you get. Year 3, year 4, it looks at, the net cash flows. That's the payback period. But when it comes to the accounting rate of return, it does not care about the timing. I hope you know the difference between, you understand the difference between taking into cognizance the time value of money and also the timing of the cash flows. The timing is that it does not care whether you have 20 years being observed. It only takes the average. It does not care about whether this one is coming in, whether in year 3 you're having a very big cash flow, or in year 1 you are having a very small. It does not care about the timing. It just takes the average. So that is a major disadvantage. Does not care about timing of cash flows. 3, It has, it is an unreliable measurement. Yes, let me say that. The accounting rate of return is an unreliable measurement. And why do we say this? For two reasons. I'll say unreliable. Now, for something to be reliable, it means, just like research, if you have an independent researcher, this is, you carry out the scientific process, you do your hypotheses, you test them, you have your models, and at the end of the day, you reach your inference, having your population size, studying your sample size, and you can now infer that what you have gotten from your tests using the sample can truly represent the population. Now, if an independent researcher comes and does the same thing, follows the same process, and he arrives at the same answer, we can say it is reliable. Good. Now, we say the ARR is unreliable because someone else can come and follow the process, maybe using a different rate of return, or maybe using a different rate for his depreciation. And even the lifespan, he might say not 4 years. He might look at it or bring a different actuarian and say, no, the lifespan is not 4 years, but it's rather 10 years. So you see that everything may change. The depreciation rate can make your accounting rate of return to change. Even the method of depreciation used can make it to change. And the estimated lifespan can also make it to change. So we say the accounting rate of return is basically not a reliable measure of assessment for projects. All right, keep following. If you've not subscribed to our channel, we want to urge you to please do so. It's the Accounting and Finance Coaching Sessions with Echela Okori. After this, we're going to look at the net present value. Thank you.